Hey, yo, Compound Live.
Nation.
Compound Nation. It's Tuesday night, 5 o'clock. And you know what that means. An all-new episode of What Are Your Thoughts? Starring Michael Batnick and me, downtown Josh Brown. Hello, everyone. Like to say hello to a couple of people in the chat. Dave Arias here. Sean Graylish. Dr. Horton is always here with us. I see Nicole in the chat mixing it up. MD, Pam Hill, all the regulars, Roger, Bob, Dave Wilson, we love you guys. Thank you so much for coming and being here for the live edition. I had a little bit of like a panic attack today on the train, and this lady's like, she's like, wait, what'd you say? Oh, are you okay? I go, no. But I had my headphones in. That's all.
Are you okay?
I'm like the whatever the opposite of okay is. Pretty much the entire day today. But I did two things that were worthwhile. And one of them was I doubled my account size on public. We're not talking about a huge size, but had some excess cash. And I said, you know what? Yield to maturity right now, I think it was like 5.2 or 5.4 or something. It was really, really easy once again. Had some cash sitting in my account at the bank. I moved it, did the purchase simultaneously with moving it. It was instantaneous. So I'm really feeling the public app, and they're a great sponsor because I actually like the product. It's like the easiest way to quickly move money from your bank and buy treasury bills.
Can I say that you're a patriot helping with the debt ceiling? We appreciate your service. Thank you.
You know, if it weren't for us patriots buying up all these treasury bills, I don't know what the government would do.
What's the second productive thing you did today?
I'm not. You know what? That's probably the most important thing I did. There's a bunch of whole. There's a whole lot of other. I'll give you one example. So you know how like I get all these emails from people that like they're just like, oh, can we have an hour meeting with you? I'm like, I never even heard of you. What are you talking about? And it's like private equity firms and like firms that want to be consultants for us. I guess they find me on LinkedIn. They guess at my email address.
Castlestone Asset Management.
But it's one bullshit email after another. So I almost never respond. I just like mark spam. This one I was like, you know what? Yes. I said, my consulting fee is $10,000 an hour. You pick the hour. We could talk about whatever you want. And I thought that would be it. And the guy goes, he's a Long Island guy too, smart ass. He goes, okay, send us your engagement letter. So wait. So I go, oh, shit, how far am I going to take this? Like, I have other things to do today. And I said, you know what? I got time. And I went on ChatGPT, and I said, create a consulting engagement letter, hourly fee $10,000. And, like, it literally created it in 2 seconds. I made a couple of tweaks to it, and I said, This is where I am right now mentally. I don't know how that makes other people feel. Am I making you uncomfortable? I apologize to the audience, but this is just where I'm at. All right. Let me just say two more things about public. When you buy your treasuries on public, your treasury bills are held securely in custody at the Bank of New York Mellon. So yeah, it's an app, but it's not like the money goes into the blockchain. It's at Bank of New York Mellon. Right. That's like where Alexander Hamilton kept his crypto. Public will also automatically reinvest your treasury bills at maturity. This is a big one for me. So I'm buying like 26-week bills. I'm not going to remember or want to even look. So it's just going to like keep rolling. And I don't know how much longer yields will be above 5%. But for right now, it's pretty cool. All right. We wanted to do something on Future Proof. Mike, did you see some of the publicity on Future Proof last week that came out?
I loved it.
Okay.
I thought the speaker list was great. It gave me back the vibes of being on the beach with friends, musicians, the Klan, Wu-Tang, I should say, not
dude,
the other Klan.
Easy.
I'm sorry.
Take it easy. We announced 50 speakers, and I'm really excited about most of them. And
we got this guy. Just kidding, but maybe next year.
Not this year. We announced Method Man and Redman. I know you're a huge rap fan. But I do like
I do like 90s rap.
You're gonna have fun. You're gonna have fun at that show.
Tons of fun, dude. That was so much fun.
I could probably get you backstage.
Is that a joke?
No, I'm serious. I could probably do it. No, like to hang out with meth. I feel like I could do it.
What do you mean? We were backstage last year.
I know, but I'm saying it's gonna be a little bit
tougher.
I
feel like you're big timing me.
No.
You could probably get me backstage.
Just fucking with you. All right, let's do the show. So this is that week where all of the first quarter 13G filings come out. And the 13G filings, for people who are a little bit new to investing, if you manage over $100 million, you have to make a disclosure with the Securities and Exchange Commission when you're taking positions, when you're buying, when you're selling. And, there is a special notification for positions that are over 5% of a company, obviously. That's what Buffett does, and that happens almost in real time. But the 13G is on a delay, and it's you have up to 45 days from the last day of the quarter. So you see all of these from all of the big hedge funds and money managers pretty much come out on the same day or the same 2 days because they want as long as they can from when the quarter ends to say what they're trading. Obviously, nobody wants to get front run. So we got a few interesting ones. Did any of these jump, before I roll through them, do you want to start with any of these in particular?
Well, I just want to let the audience know that, of course, this is backwards looking, and some of these are much more meaningful than others. For example, what Buffett bought 45 days ago, whenever it was, there's like a 99% chance that he still holds that, right? He's not trading.
That's a good point.
He's not trading. Einhorn probably falls in the same bucket. I don't know about Michael Burry. I don't know how frequently he's turning his portfolio over, but I feel like there's less signal in that than a Buffett or Einhorn.
I think Burry is more likely to trade opportunistically because we know that he follows every tick in the market because he's tweeting about it. So I think more so than like an Einhorn or a Buffett. He's much more likely to see regional banks getting crushed and being like, you know what, this is too much. I'm going to take the other side. But I don't think he's building positions in these companies. I think he's probably in and out. I think so too. I mean, just like based on his prior filings and comments, it doesn't feel like he's trying to amass positions. It feels like he's trying to take the other side of volatile markets and capitalize.
What was the most interesting thing in here to you?
Well, assuming he's still in these stocks, maybe he's not. He bought in. I mean, he can't still be in First Republic. And again, this is the first quarter, which ended March 31st, right? So we don't really.
It's very stale. It's very
stale. So Scion Asset Management is Burry's fund. They said he more than doubled the dollar value of his portfolio to $107 million. He's obviously not trading billions of dollars. I'm sure most of this is his own money.
His own, yeah.
I would get. That would be my guess. On screen, what you're looking at are some of the buys that he did and a couple of reductions. JD, Baba, New York Community Bank stands out. Zoom is interesting. Capital One is interesting. But again, he could be out of some or all of these by now, for all we know. But he was being opportunistic about the regional banks in at least as recently as the end of March. I guess not terribly surprising that he has a view. Maybe most people would have guessed he would have been shorting these, right?
How bad? Yeah, and also there could be some funky stuff where he's like buying to offset shorts. Like who knows? There's some. Zoom looks so bad. It can't bounce even for a second. It's down. It's at an 88% drawdown.
It's like the one I'm in DocuSign right now, and I refuse to buy Zoom.
I don't want anything to do with Zoom.
I'm
saying the chart looks awful and the business is awful.
There is no moat. There is absolutely no way to stop every other platform from building a video feature. They all have.
Every single time I do a Google Calendar, I just add the Google Meet. Every single time. And we pay for Zoom.
How about spontaneous meetings based on a Slack conversation?
Slack huddle.
All
the time.
Same thing. Why does anyone say, "Hey, this is too convenient. Let's pop over to Zoom"? So it's a tough sell.
So Zoom has and it still has a $20 billion market cap. Who knows where it bottoms? By the way, remember, I know we spoke about this. Zoom really was a poster child. It was bigger than Exxon.
Yeah. There was also this feeling that nobody would ever have an in-person meeting again. That was kind of
a lot of that is largely true. I mean, in-person meetings are in a 90% drawdown.
All right, more 13Gs. David Einhorn.
How about Appaloosa? Go ahead, Einhorn.
Let's do this one because it's also regional banks. He bought First Citizens, which I think emerges from this as a big winner. Which did they buy Signature or they bought Silicon Valley?
SVB, yeah.
Okay. And then the other one, New York Community Bank, which was just absolutely hammered. And New York Community Bank has a ton of Long Island branches. So, like, you and I know them. Like, we pass by a New York Community Bank pretty much every day.
Oh, yeah?
Yeah, pretty
Can
much.
I tell you something about you might not know about me? I am extremely unobservant. I don't notice my surroundings ever.
Oh, well, I'm telling you that you do.
New York Community Bank?
Also, Westbury Music Fair is the NYCB Theater. Do you know that? You must know that.
No,
On
I don't
Brush
know
Hollow
that.
Road? Okay.
No, I know where
All
it
right.
is.
They bought Signature, New York Community Bank.
Right.
And First Citizens bought SVB. And Einhorn scooped up both of those names, which I thought was kind of interesting. You want to do Appaloosa? So Tepper's managing his own money now. He's not really a hedge fund anymore. I mean, he is, but he's like a family office, right?
I wonder if he's. Is he still actively pulling the trigger, or does he have somebody else doing it for him?
I'm sure it's somebody doing the physical trading.
He
but
probably
him
oversees
being
it.
Him being like yes or no. Yeah, I'm sure it's something like that. I mean,
So this got some attention. He bought how much worth of ARK? $20 million, which is 1% of it.
he's already out.
Could be.
No. He's definitely already out. I think he told Scott Wapner that's old news. That trade.
Well, guess what? ARK had a good bounce. So
Yeah, but what's interesting is he bought Alphabet, he bought Amazon, he bought Uber. Those are my three tech
Huge.
positions. These are big purchases. So let's
Huge.
let's go through these really quickly. He bought 2.1 million shares of Google for almost $250 million.
Yeah.
He bought 200 million worth of Amazon, and he bought almost
no, Josh. Whoa. That's the value. That doesn't necessarily mean that that's what he bought. That's
what
the
do you
total
mean?
value.
The total value of his position.
Yeah. So we don't.
Well,
so
So he's up to that many shares.
no. So he added a third of that. So he added whatever.
Yeah, I see what you're
67
saying.
million.
The Uber ad was big, though.
That's huge.
He 4x'd his position.
Yeah.
6 million shares worth 190 million, and he reported
monster.
price, which I don't know where they get this, $31.70. I was not aware that they had to report a price unless they're using March 31st close to come up with that, or maybe they do disclose.
No,
their
they
average
probably.
price.
I'm sure it's disclosed. Yeah.
And he bought some Meta too, and he added to his Microsoft. You know, the big tech thing, we talked about it today on TV.
David Tepper's taking my sloppy seconds with Meta. Just kidding.
Take it easy. What was I going to say? Oh, these are like basically now morphing from being FANGs to being AI plays. Like, let's
More
just
on that
call it what
later.
it is.
More on that
Yeah.
later.
Let's just call it what it is, though. That's what's going on. Every one of look, there's a thing on TV tonight, I think. Satya Nadella wants to sit down and talk about AI for an hour with David Faber or something. Like, this is the new thing that they're all going to want to do, is position themselves as AI leaders. And you're going to hear a lot less about social media, and you're going to hear a lot more about AI. And that's what's going on. And these stocks are working in part because of that dynamic. Not the only reason. Are we doing any others? Bill Ackman added Alphabet. Looks like he bought both share classes, which I'm not 1,000% sure why. These are new positions. He bought 8 million shares of the Google A shares, and then the B shares have an L on them, so some people call them the L shares. This is just voting rights. It doesn't really matter. It might matter to Ackman. It doesn't matter to most of us. He snapped up 2.1 million of those. So I thought that was interesting, and probably for the same
How about
reason.
Chipotle? Chipotle had a massive gap up after earnings, and it's not giving any of it back. Not a cent.
And he's been a seller because he owns that stock way lower. He crushed it in Chipotle. And I remember they were like mocking him with pictures of him in the store online.
Well, remember when it was giving everyone diarrhea? They totally were. This was a long time ago.
They were calling him Taco Bill, which I think is kind of funny. When you're right, you're right. He bought the panic over what do they have, Listeria or something? I don't even know what the problem
And
is.
I think Einhorn called them like expensive. Like, remember, was Einhorn short Chipotle like a long time ago, calling them expensive Taco Bell or something? I can't remember exactly. Anyway.
That stock is
Monster.
massively worth.
Monster.
All right, look, here's my big takeaway though. It's interesting to see some of the most famous, well-known hedge fund guys, plus Buffett or family office guys, buying the bank panic. We didn't get to Buffett. Buffett actually sold some banks, but then he bought Capital One. So
That's interesting because Capital One is like a pure play on the consumer, right? It's like all consumer credit risk.
So Buffett used to have a lot of like traditional bank shares, and he's pretty much out of all of it other than Bank of America.
So wait, what? Wells Fargo, American Express.
No, put American Express in a different category.
Okay.
Wells Fargo, Citi,
Bank of America,
JP Morgan, Goldman. Like he's like gotten out of all that stuff. I think he's still in Bank of America in size. The others he seems to sell a little bit every quarter. I think he might be all the way out of Bank of New York Mellon this quarter. But then U.S. Bank Corp he was selling, which is a big Minneapolis. But the one he's buying is Capital One, which if you were bearish on the consumer or on consumer spending, you would not be buying that stock. And actually, that's a little bit of a battleground stock. They're in like a war with Walmart right now.
For what?
Apparently in 2018, they did this big joint venture partnership with Walmart. And then Walmart just like pulled out of it abruptly last month. And Capital One is like, oh, here we go. Walmart's about to launch its own credit card business, right? So I don't know. And the stock's been it's been rough sledding for COF.
Yeah, really rough.
Like it's not crushed, but
it's crushed. It's crushed.
This stock 2 years ago was 177, and now it's 90.
Yeah,
so yeah, it's pretty bad.
Crushed.
But Buffett sees value, and Buffett knows this business. Todd and Ted were big fans of, I think, Visa and MasterCard, or both. He's owned American Express since 50, 60 years. So he knows this business, and there's something about the opportunity in Capital One that they like. Maybe it's the 6 times earnings that the stock currently sells for. Maybe it's the 2.5% dividend yield and PE ratio of 6. Maybe it's the fact that the market cap has gone from 70 to 30 billion. Like these could be reason enough to take a shot on that. All right, let's keep it moving. What do you got?
Well, let's talk about some positive surprises. This tweet comes from Ryan Dietrich. The data is from Ned Davis Research. This will upset a lot of gloom and doomers, but oh well. S&P Global Composite PMI is at a 16-month high. This combines manufacturing and services. Per NDR, it is also higher 5 months in a row, which is consistent with the early stages of a global recovery, which is interesting because I thought that we were in the late innings of an expansion. So did we skip
already in a recession?
we recovered from the non-recession? I don't know what to make of this. This is blowing my face a little bit.
Well, it's global. So let's just I don't know how it's weighted, like what regions, what countries. But let's just include that in the discussion. The other thing is like all of this shit is broken. None of the readings you're getting from any of this stuff makes any sense compared to the other readings. Like like everything in context makes no sense at all, and we're still there. Like these.
Oh, it's such a good point. Today,
these
Ben
things
and I
will heal, but we're still broken.
Today, Ben and I were talking about like people's satisfaction at work, which has been up and to the right for basically the last 15 years. I'm like, how are we at record highs in terms of people's happiness at work when everything is seemingly so busted? It's very hard to square a lot of the soft data and hard data.
Because they're not really working. Do you know what like the typical person does at work?
Oh, stop.
Facebook.
Stop.
All day.
Okay. All right.
You'd be satisfied too.
I will not entertain this nonsense. Next chart. This is also from NDR. This is great. So the blue line is the S&P 500, and the orange line, or the orange bars, are the percentage of S&P 500 companies with positive earnings surprises for the prior quarter. And you saw it came all the way down as stocks got crushed in the first quarter of 21.
Wow, look at this.
Right? So we did the thing. We did it.
Like you had it.
Estimates came way down, stocks got crushed, and now we're recovering.
How about double dip? Can we do it? We could do a double dip. Don't get too confident.
No, we
Look,
could.
put it back
we
up.
could. I'm looking at the chart. Where do you see double dip? 98 a little bit.
I don't know. I see about 30 of them.
All right.
I mean, come on. I'm not saying we have to go back down to the trough, but like it happens.
Could happen.
I mean, what couldn't happen?
Right.
Yeah, I'd believe anything. If you came back in the DeLorean and got out of the car and handed me a Wall Street Journal from 30 years from now, everything you say, I would say, yeah, that could happen. I believe anything.
Yeah, anything is plausible. I agree.
By the way, do you know what year in Back to the Future 2 they travel forward to? Do you know like
2002?
what? It was like 2015.
Yeah.
It's amazing.
Yeah.
Oh, it's amazing. All right. I wanted to do this wealth transfer thing, and I don't know if the New York Times is overselling this or what, but they say an intergenerational transfer of wealth is in motion in America, and it will dwarf any of the past. Of the 73 million baby boomers, the youngest are turning 60, the oldest boomers are 80. Blah 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 blah. All right, this is the point. In 1989, total family wealth in the United States was about 38 trillion, adjusted for inflation. So in today's dollars, by 2022, that wealth had more than tripled, reaching 140 trillion. Of the 84 trillion projected to be passed down from older Americans to millennial and Gen X heirs through 2045, 16 trillion will be transferred in the next decade. That's a lot of money in motion. 16 trillion in 10 years.
Yeah.
Like relative to the whole pie, it's like more than 10% of the whole pie from what their numbers are. John, throw this up. Chart on, my man. So baby boomers hold half of the nation's 140 trillion in wealth. And pay attention to the top right, Gen X, which is me. And we've got about 47.8 trillion. And then the millennials are only at 14.2. That's the big thing that's about to change. So when you ask, like, why is home builder confidence rising? Why is, like, the housing market not falling apart with rates collapsing? Because of this because of this very transfer.
This is kind of
That's
interesting.
where the money's going.
This is sort of a side point, but millennials allegedly have $2.5 trillion in pensions. I wonder if like 401ks are included in that. Must be.
They might just be using the term pension as a catch-all.
Yeah, it must be.
Does it say it down here? Pensions include the present value of future benefits as well as the value of annuities sold by life insurance companies.
So maybe it actually is pensions?
Yeah, they're including annuities. And what millennial doesn't have an old college roommate selling them annuities? I mean,
imagine.
All right. The wealthiest 10% of households will be giving and receiving a majority of the richest. All right. So this is the New York Times being the New York Times and making it like a bad thing that wealthy families are good at passing money down to their heirs. They're saying the top 1%, which holds about as much wealth as the bottom 90%. Okay, maybe that's not great. And is predominantly white, okay, will dictate the broadest share of the money flow. The more diverse bottom 50% of households will account for only 8% of the... All right, so that's crazy. Like, you're going to see most of this wealth changing hands amongst wealthy white families. I mean, nobody's surprised by this, but...
But there is a flip side. There's a flip side. I was talking about this with Ben today. There is more philanthropic efforts today than there ever has been before. So while there's more wealth being transferred, not 100% of this money is going to the next generation. Not even close to it. Or maybe close to it. I'm sure the majority is. But there is literally trillions of dollars that will be used for good purposes.
I mean, just going by like our top 20 families, just think about the sheer amount of conversations that they're having with their advisors at our firm about
giving?
philanthropic.
Yeah.
I mean, it's
tons.
It's almost the whole thing. So I think that's a good point. I think that's worth pointing out. People not only want to give, they don't wait until they're dead. They actually want to see the results of their giving while they're alive. And that's different than the silent generation where they would like literally silently, all right, here's all the money I'm not leaving to my family. This is very different.
Let me tell you this. Over the weekend, I had my father over and my sister, and my dad said, I want to give the grandchildren a check for their 529. And that's not a conversation that we've ever had, but that's a perfect example of some money in motion. I do also think that, actually, I don't think anything. Let me ask this to you. What do you think the stock market ramifications of this are? Because we've been talking about 10,000 boomers a day retiring for almost literally 10 years, I feel like. It's happening. People are getting large inheritances.
Yeah. But what do you mean the ramifications?
I don't know.
Nobody sells.
Right.
Nobody sells. And that demographic, what's that guy's name?
You be more specific. The guy with the hair?
No, the guy.
With the eyes? What guy?
With the demographics.
Harvey Dent.
Harvey.
No, Harry Dent. Is it Harvey's from Batman?
Harvey Dent is from Batman.
That's Two-Face, yeah.
So I told you that was sucker shit years and years ago, where there's going to be like this moment where all the boomers dump all their stocks at once.
That's nonsense. Demographics are destiny in a way, but that's
nonsense. He's like a professor of demographics, and he wrote like 12 books about that.
Demographics matters obviously a lot in terms of
this is important because part of the gist of the article, Doug Bonaparte's in this article actually.
Shout out to Doug.
Shout out to Doug.
Seeing Doug
but
on Thursday.
Part of the gist of this article is that the amount of wealth has grown so much, and like nobody sells. Like you can live the life of a rich person and keep your assets
and borrow against them.
But that's the point. Here, a key reason there are such large, soon-to-be inherited sums is the uneven way boomers superbly benefited from price growth in the financial and housing markets. The average price of a U.S. house has risen 500% since 1983, when most boomers were in their 20s and 30s. So they got that benefit. Okay, we know that. The stock market, as measured by the S&P 500, is up 2,800% since the beginning of 1983. So almost 3,000% in 40 years. And then they one more chart. John, throw this up. This is just showing like where everyone is going to be in terms of like the annual wealth that's going to be handed off. So Gen X, you can see, is going to peak in their inheritance circa 2037. So what is that? Like 15 years from today. The millennials, it just goes straight up for the next 40 years and 25 years and does not stop. And then you see Gen Z. It's just like it hasn't even started yet. So I thought that was kind of interesting. But the gist of the story is that like it's a whole different world now. If you don't own assets, like if you're like just working for a salary, you're just not in the game that's being played right now. The whole game is owning assets, having their value compound, borrowing against them to fund your lifestyle, and never selling.
What does stock-based comp look like today versus 40 years ago? I think like we're on to it. Yeah.
How about 401k contributions now versus 40 years ago? So that is
the secret's out.
Which is why this is the most important show on YouTube, to be like perfectly honest. Like I understand you guys are into like UFC or whatever, watching people play fucking video games, but honestly,
Is this a backhand? Is this
this is the show that you're supposed. This is the show that like watch the other stuff too, but like really don't miss this because this is the whole game. This is if you don't understand this stuff, you're just like blindfolded, tripping over things.
Well, they understand. Like, they're here.
I know. My guys understand. My guys and gals. I know.
All right. This is a great chart from a gentleman whose name is Todd Sohn.
I like this chart.
What we're looking at here are, well, let me just read it. The S&P 500 just broke a streak of 12 consecutive months with a negative rolling 12-month price return. In other words, for 12 consecutive months, we had a one-year return that was negative. And now we broke it. It's not negative over the last 12 months. This is historically very rare. Forward returns are decent, although mindful of some of the tougher cycles. So this is not foolproof. There is no foolproof indicator. Nothing is perfect. So this is like a pretty decent track record. In other words, once you've had a long period of negative returns and that stops, forward returns are decent.
But you're saying forward returns are better than average after a period of consistently negative month after month returns.
Well, I don't know what the return average is, but what I do know is that after this has happened, there was never stocks were never down in the following 12 months. Doesn't mean it can't happen this time, but keep in mind 1, 2, 3,
Right.
4, 5,
We're
6.
right.
So 9 times.
We're talking
Last
about probabilities, but
last
of
9
course,
times. So it's decent.
it's pretty
good.
decent. I had Sean look at this for me today. The stock market is exactly where it was 24 months ago. So I said, when was the last time you had a flat 2 years? And what have we historically seen after, like, chart off? What have we historically seen as like the aftermath of like a market going nowhere for 2 years?
Survey says.
And here's what he said. He looked at rolling 24-month periods. So not calendar, but like 24 months where the S&P makes no progress. Going back to May of 1950, it's happened 24 times. So that is a gain or loss of 1%. So this is only 3% of all rolling 24-month periods going back to 1950. So in other words,
they probably also cluster too. So how many distinct periods?
Extremely rare. There's nothing really there. The average return 12 months later, after the S&P is flat over 24 months, is plus 6%.
So
and that's going back 75 years. So is that it's about average?
Yeah, no, below average. So anyway, I thought that was listen, in a sea of this is a lot of easy negative charts to find. I'm trying to highlight the positive.
Okay, I like it. Can we just like do this Hindenburg versus Icahn?
Ooh, I've got a lot in here.
All right. All right, it's my topic, so I'm just going to set it up quickly. I think most of our viewers are aware that there's some shit going on with this. And
it's spicy.
I don't really have a strong opinion on it. I never really followed IEP, but that is Carl Icahn's publicly traded. It's not quite a closed-end fund.
It's an MLP.
But it trades at a premium to the assets like a closed-end fund could.
Right.
But basically, this is Icahn's only investment vehicle. There's not like another hedge fund. So like this is what he...
All of his it's like 90% of his net worth or maybe more.
His whole net worth is in this. So the price really reflects his like... And he's 87. So this is like everything he's accumulated is in this fund. And it just had the shit knocked out of it 2 weeks ago when Hindenburg basically said it resembles a Ponzi scheme. It's the assets are all being marked up from an accounting perspective to more than they're really worth. And 85% of it is owned by Carl. 15% of it is publicly traded, and it's mostly retail, which I think is why the investigators took a look. They don't like when they hear retail being screwed around with.
And the word Ponzi, they take that
And
seriously.
they don't like the word Ponzi either. So anyway, Hindenburg put out his report, and he's basically saying, look, they're returning your capital to you. Like if I think they said you're buying $9 worth of assets for $32, and Carl is paying you back $2 a quarter, and it's your own money. Like that's the way that he's framing the return of capital versus the premium to assets. And so that's the story so far. And then Icahn Enterprises basically fired back, and they said, oh yeah, reiterating, we're paying our distribution. That got the stock a pop. And then the next day, I guess it's the Southern District of New York, came out and said, actually, we're taking a look at Icahn, and there was an information request. Or they didn't say it, Icahn disclosed it. One or the other. But this has gotten serious, and there's an article at Yahoo that it was a Bloomberg article that basically details all of the potential run-ins that Icahn has had with the law in his very long career. And this, they're saying, seems to be the one that could be the most serious. So let's just throw this chart up of IEP just to give people like the lens of what's been going on.
Smoked.
And then, Michael, I want to hear what your thoughts are.
Yeah, there's some smoke here. There is some smoke. So that's the total return price. So Hindenburg laid out that they inflated the assets, like you said, Josh. They laid out the case of what most closed-end funds trade at in terms of they said most closed-end funds trade at a discount. This is trading at a premium. They looked at dividend yields and just across the board, the asset value, the cash flow. So, for example, the dividend is entirely unsupported. I'm sorry, let me back up. Okay. The company's outlier dividend is made possible for now because Carl Icahn owns roughly 85% of IEP and has been largely taking dividends in units instead of cash, reducing the overall cash outlay required to meet the dividend payment from remaining unit holders. This is important. The dividend is entirely unsupported by IEP's cash flow and investment performance, which has been negative for years. The investment portfolio has lost 53% since 2014.
That was crazy. I mean, I believe it, but like, wow, that's really bad.
The free cash flow shows that they have cumulatively burned $5 billion over the same time period. Despite its negative financial performance, they raised its dividend 3 times since 2014. So, okay, they're talking about how they're marking up the valuations. They said in one example, IEP owns 90% of a publicly traded meatpacking business that it valued at $243 million at year end. The company had a market value of only $89 million at the time. So that is very smoky, right? So they're marking it up by 204%. Now, the problem is, former federal prosecutor said valuation cases are hard to make because the prosecutor has to show that the valuations are intentionally inflated. It's not enough to say that they're wrong. It's not enough to say that they are well-grounded or not well-reasoned. You really have to show that there's an intent to inflate them. If this is the case, then you can make the case.
The other thing is, if Icahn is taking all of his quote-unquote dividend, it's really a distribution. It's not a dividend, I think, right? Like the actual term. If he's taking it in stock, it's going to be hard to prove that he's deliberately taking units of a Ponzi scheme of his own making. Like, wouldn't a Ponzi schemer be pulling cash out? Just thinking out loud.
But look at the shares outstanding. So all right, let's go through the charts. So look at the shares outstanding. And this is the part that they're probably looking at. It's like they're just issuing to get retail in. At least that's the allocations.
But also, it's paying like a 15% dividend yield before this whole shit show started.
Previous chart, John, please.
It was the highest. I think it was the highest dividend in maybe the S&P 500 or something.
Like, yeah, by a lot.
Like it's a ridiculous level of income to be paying out, which is probably why it attracted the attention of short sellers, or maybe one reason, because it like sticks out. Wait a minute, let me get this straight. Your portfolio has been cut in half, and you have the highest dividend yield in the market. Let's pull that thread. Like it has to be part of the thought process.
So it's the highest dividend yield of any U.S. large cap company by far, with the next closest at 9.9%. As a result of the company's elevated unit price, its annual dividend rate equates to an absurd 50.5% of last recorded indicative net asset value. So, I mean, they're going to look at this.
Can I ask you a philosophical question?
Please.
Why is he doing this?
Carl Icahn?
Like Hindenburg was like, he's a legend. Like,
yeah.
But why are you 87 years old?
Dude, none of this happens overnight.
Doing this.
None of this happens overnight.
I know, but just get out of the arena already.
Can't. It's cumulative leverage, and it's really hard to unwind. So here's
that's the other part. Right. So Hindenburg's like,
you got to keep it going.
Show us your margin. Like, how are you literally doing this? And it's a fair question.
It is. There is irony here, though, that Carl Icahn is one of the most famous activist investors of all time, going after companies for shenanigans.
Bomb thrower.
So, okay.
Decades.
Icahn said, quote, Hindenburg Research, founded by Nathan Anderson, would be more aptly named Blitzkrieg Research, given its tactics of wantonly destroying property and harming innocent civilians. Mr. Anderson's modus operandi is to launch disinformation campaigns to distort companies' images, damage their reputations, and bleed the hard-earned savings of individual investors. But unlike many of its victims, we will not stand by idly. We intend to take all appropriate steps to protect our unit holders and fight back.
All right, listen, we don't really know what's going to happen here, but it seems like it's not going to stop anytime soon. But like the bigger question is like Icahn's already on Mount Rushmore. If he would have retired 10 years ago, he'd be on Mount Rushmore, I think. I don't think most people would even argue that. I remember Leon Cooperman had like an insider trading problem, and like he was being investigated, and then he settled it. He lost all his outside investors. But I remember thinking to myself at the time, it's like, you're 70. Who gives a shit about this stuff? You're a billionaire. Go feed the ducks. Like, that's what I would do. Maybe I'm wrong about myself, and I'm never going to be in that position, so it doesn't matter. But like 1B seems like pretty good and enough to get out of the arena. Who needs
Hindenburg
They
also
don't
said,
all. There's a lot of retirements.
No.
Dude.
Listen. They have no institutional coverage except for Jefferies, who happens to be the only bank that does their deals. And I don't.
It's also not great.
So listen, we'll see. But I would say that Hindenburg made a compelling case. Let's just say that.
No, I agree. And the stock's lack of recovery tells you that the market is like paying attention. This is not something that just got like swept under the rug. This is ongoing now.
And and Icahn was talking about how the bets he's made against the market over the last. I remember in 2015 he was calling J&K a powder keg. Like he's been bearish for a long time in the market. So
ahead.
It's been a tough run.
Anyway, you know how I always tell you when I turn 50 I'm going to disappear?
What are you talking about? It's in like 6 months.
No, it's not. No, but that like I'm gonna just go. I'm gonna be done. I'm gonna be out of the arena.
All right,
I'm not fighting
relax.
anymore.
You don't have to like.
These guys are 90.
So why do you think you're so different? What is wrong with you?
I know I'm different.
Okay.
I know it. Like
No, you don't.
If I ever got to that level of success, I don't think I would even get there because I would have been like done earlier.
Yeah, doing what? Doing what? Doing what?
Not
playing Minecraft.
Not fighting with activist short sellers and doing
you are
15% dividend payouts. I definitely wouldn't be doing that.
I agree you're not doing a 50% dividend payout, but you don't know yourself. Okay. Next topic.
You know me better than me.
I do.
Let's keep going.
All right. AI-related stocks drove virtually all the returns of the S&P 500 this year. So the gray line is the S&P ex-AI boom stocks. So I guess... what would this be X? And it's not disclosed. I'm guessing like Nvidia, Google, Meta. We spoke about this last week.
We don't know what's in. We don't know what's in this. What's in this? What's in the?
So there's no doubt. There's no doubt that AI is helping these companies a lot. But it's also a combination of the crazy rebound after getting just destroyed from 2021 to 2022. This chart is a face blower. Chart on, please. So this is the NASDAQ 100, which relative to the NASDAQ 100 equal weight, which would favor the smaller companies. And this got smoked, right? Meta down 70, Amazon down 50 plus, Google down 50. This got smoked. Look at this rebound. This is insane.
Yeah. So you said it's like 60% AI, 40% where these stocks are bouncing off of. And I think that's right.
Yeah,
I mean,
it's something like that.
The percentages could be wrong, but
it's something like that.
I think it's a combination of you have stocks that were cut in half or worse that are some of the highest quality companies in the world. Some of them facing specific issues that they were in the process of fixing. And then you've got this tailwind of AI excitement that comes along at exactly the same time.
Huge tailwind.
And voila.
Just look at the Nvidia, Microsoft. I mean, these stocks are on
the S&P
fire.
would be down this year if not for this AI bubble that we're in the process of blowing. And I think it's first or second inning.
I think it's way early.
The shenanigans that we're going to see in the second half of this year.
Do you know why? There's no penny stocks. There's no IPOs.
No, it hasn't even started yet.
No, early.
So I said there's three things going to happen. The first is you're going to see a lot of shitty companies change their name or their business strategy or whatever to AI, something AI. Like you'll see about 100 of those. They don't matter because they're small market cap and they're really just like schmucks will lose money. But that'll happen. The second thing is the IPO machinery is cranking up, and you're going to get some massive AI issuance coming along, probably more next year than this year. And then the third thing is you're going to see a really dumb acquisition. Someone's going to do some sort of desperation AI takeover. But like none of this has happened yet. None of it. That's how early.
Yeah, that's early. Okay.
That's how.
All right, I'm gonna make the case, Josh, for a company that I do not own, and that company is called Booking Holdings, ticker BKNG, owner of Booking and OpenTable and all sorts of brands. So they reported.
What do they own? It's travel and restaurant.
Let me. This is.
Is it hotel? Is it hotels.com part of this?
No, I don't believe so. So it is, let's see, brands. Kayak, OpenTable, Rocket Miles, Fair Harbor, Hotels Combined, Cheap Flights, Momondo. I mean, there's more, but
okay.
Okay.
But it's consumer leisure spending.
They're crushing it. You know why? The consumer's doing okay. Gross travel booking which was total dollar value, was $39.4 billion, an increase of 44% from the prior year. Room nights booked increased 38% from the prior year, and that's off of tough comps. Okay, last year people were traveling. Total revenues were up 40%. Net income was $266 million, compared with a net loss of $700 million. It's all good stuff. Adjusted EBITDA was $586 million, an increase of 89% from the prior year's quarter. Chart off, please. So the CEO, Glenn Fogel, which makes me think of Superbad, said, quote, "We saw a strong start to the year with first quarter room nights and gross bookings reaching our highest quarterly levels ever, and both metrics surpassing our previous expectations. This is some bullshit. Charts, please. Free cash flow. I mean, look at where this is now compared to pre-pandemic. And there's so many companies like this. So many companies. So this is the leader in the group.
I was going to ask you, why do we like Booking better than, let's say, Expedia or some of the other I don't think there were that many left.
Look.
Why is this the one? It's just the best chart.
Because they're winning.
Yeah. Oh, clearly. Look at this.
This is 1 year.
Wow.
They're just they're
what are they doing? What does the Wall Street think they're doing so much better than these other guys?
I mean, I can't speak to that. I would just assume that they're just executing better. I don't know. The chart is really interesting. So it has failed twice in a pretty big way at this level. So I would rather buy higher than buy here. I would also add on a pullback, and I actually might buy this if it does pull back, because this thing is.
You're not worried that we're right now in the midst of the best things will ever be.
Could
for
be
consumer travel.
Could be.
It feels toppy.
Could be.
Not the stock chart, because that could keep going. The moment feels toppy. Like everyone was pent up to take trips for 2 years.
Well,
and they all went and took them.
Airbnb, which I do own, guided lower because they were talking about really difficult comps. So the fact that Booking is still crushing just seems to me that it's more of them killing their competition than it is like the pie is shrinking.
I mean, clearly they're doing something right that the other guys don't seem to have going for them. All right, let's do a mystery chart, and then we'll get out of here. This is mostly consumer, but not all.
Oh, I know this chart. Oh wait,
I wanted to make the point. This is every 5-year chart you could find. Pretty much every 5-year consumer-facing brand has this chart.
Is this Home Depot?
It is. Look at you.
Told you I knew this chart.
Bang! I'm so proud of you.
Thank you.
Good. You're good. Here's the story.
I've got a chartographic memory.
So, they're saying that annual sales will be down this year. That is the first time since 2009. So it's been a really long time since Home Depot has had a down year.
Everybody pulled forward.
Right.
It was the biggest miss in 20 years.
But especially Home Depot. Talking about pulling forward.
Right.
Annual revenue in 2009 was $70 billion. This past year it was 160. So they'll have a 2 to 5% fall in sales. People could live with that.
You know what?
Hold on. Revenue was down 4.2% in Q1. It was $37.26 billion. Still a huge business, just lower than Wall Street's forecast. Same store sales were down. Average ticket price was flat. Foot traffic was down. All the things that tell you people are calming down. I feel like that's okay. The stock was $415. It's where did I say it is?
It's 280. It's in a
all right
32% drawdown.
I think you're going to get the stock closer to 200 before.
Oh wow! I was going to say if it gets to like 240, if it gets to like the 2019 high.
Do you see the support from 22?
Yeah, I was going to say
I think it's going to break it.
So I might buy it. What's more? I mean, not yet. If this thing has a hard break towards like 240, 230? What's more American than Home Depot?
It's a 20 multiple. So here's the
buy
problem.
And put it away.
Here's the problem. If you look at like any of the multiples, like enterprise value to free cash flow, like all of the important multiples for a company like this, it's not at a discount to its 10-year median.
It shouldn't be.
On any of them.
It shouldn't be.
Well, no. So my point is, before you buy it in this environment where they're now telling you earnings will be down 7 to 13%, revenue will be down. before you buy it, wouldn't you like just be like, well, am I getting it cheap? No, you aren't. And
No,
I think you will.
I'm saying I agree
will.
with you. I think you can get it lower. I will be stalking. Right. I will be stalking like a lion.
All right. Hey, everybody. Hope you had fun with tonight's edition of What Are Your Thoughts? Michael is stalking stocks like a lion. Tomorrow morning is Wednesday morning. So you know what that means.
Announcement.
What?
We got Animal Spirits tomorrow. The Fed shirt is back. We've had a lot of people ask for that.
Yeah. We did it in white for the summer.
I like
it. Do we have a picture of that? Okay. Maybe we do, maybe we don't. It's idon'tshop.com for the latest in financial blogger apparel. The Fed shirt is officially back, and
are we doing a limited release? Because I don't like that. Let's just leave it up for a little bit. People want it.
No, we do a limited release.
And
then we take it away.
Don't like that.
We don't have unlimited space in the store for like different items. We don't want the store to turn into
there we go.
Baby Gap. That's dope, right? Look at this thing.
I love it.
We sold a ton of these when it was in black last year.
Need a V-neck.
Now it's
love
back for the summer. So, all right. New Ask the Compound with Ben on Thursday at 1:30 p.m. live on YouTube. And then we will be back at the end of the week with an all-new Compound and Friends. And wait till you see who we have on this episode coming up. You are going to love it. All right, guys. Thank you. We love you. Have a great night. Hang with your families. We'll pick this up tomorrow.